welcome to the Sterlite Technologies Limited Q4 FY19 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vishal Agrawal, Head, Investor Relations, Sterlite Technologies Limited. Thank you, and over to you, sir.
Thank you, Lizanne. Good evening, everyone, and thank you for joining us today. With me on the call are Anand Agarwal, CEO of STL, and Anupam Jindal, CFO of STL. Anand will begin with the key highlights and initiatives of FY19, and then we'll round up with our outlook and strategic focus for FY20 and beyond. Anupam will then take us through the financial performance and financial priorities going forward, after which we'll open the floor for Q&A. We have also uploaded the presentation on our website for those who cannot access it live right now. Before we proceed with this call, I'd like to add that some elements of this presentation may be forward-looking in nature and must be viewed in relation to the risk pertaining to our business. The safe harbor clause indicated in our presentation also applies to this conference call. Now let me turn the call over to Anand.
Thank you, Vishal, and good evening, everyone. Before I begin with my comments, I wanted to take a moment to thank and compliment the entire team of STL for the tremendous performance and accomplishments in the fiscal year. I'm extremely proud of our team's passion and zeal to build the STL of today. We have grown from about 3,200 crores last year to an all-time high revenues of about 5,100 crores this year, which is a massive jump of almost 60%. And I'm equally proud of how we serve as a trusted partner to our customers as they transition from one technology era to the next, as they transform their business model to generate value for their end customers. I would start my comments by giving you a quick snapshot of how this year shaped for us. And this slide is particularly my favorite because it showcases the seeds of the exciting times that lie ahead of us. During the year, we launched 6 new solutions. We won 35 new customers. We acquired Metallurgica Bresciana. We took decisions on growth and executed capacity expansion, and are wrapping FY19 with 271 patents and an all-time high order book of more than 10,500 crores. And in the next few slides, I will talk about some of these developments in more detail. Now, coming to what led to our growth in FY19, I think I would break it into 2 parts. On the connectivity solution side, which is the product side, we saw increased fiber deployments in Europe, in India, as well as the rest of the world, which are now amongst the strongest markets for our optical solutions. On the flip side, though, China's demand was relatively flattish this year, which now accounts for less than 5% of our overall revenue. We also made an entry into 2 of the top 5 global cloud providers that are heavily investing into future networks. I would say our inroads into new tier 1 telcos and high value-added products and solutions paved way for the growth in this year. On the network services and software side, we partnered with top 2 telcos in India on their network design and rollout. We also saw new customer wins of tier 1 telcos for our BSS OSS software platform. And the other part of the demand came from the national broadband initiatives of BharatNet and state-led initiatives of smart cities, where we secured orders for network rollout in state of Maharashtra, and we see an equally strong pipeline of orders in coming quarters. From the large enterprises segment, it was largely on accounts of spend on network modernization by defense as well as power and utilities, which included our marquee win with Naval Defense for building their state-of-the-art digital communication network. On an overall basis, I would say that the company's focus in FY19 has been largely into India, Europe, Latin America, which amounted to almost 90% of our revenues. Now let us look at how all of this translates into numbers. If we compare ourselves to what we were 3 years ago to where we are now, we see that apart from strong growth in revenues, our customer mix also is evolving. We have significantly strengthened the new customer segments like enterprises and citizen networks, and we have created added focus on cloud companies. A good chunk of revenues, almost 37% now, comes from these new segments, while we continue to deepen our engagements with global telecom providers who will continue to play an integral role in our growth journey. In terms of geographical mix, our export has grown by more than 3 times in the last 3 years, with Europe becoming an extremely strong market for us. We are now partners of choice for the largest telcos in Europe, in India, with our suite of connectivity solutions. And closer home, we are partnering with a tier 1 operator for one of the world's largest greenfield 4G rollout. And this year marked the beginning of another new segment for us, which is the cloud providers. We have made our way into 2 of the largest global cloud providers. At the same time, we remain extremely focused and have deep engagement with select few customers, which is evident from our customer profile, where roughly top 20 customers account for more than 75% of our revenues. As a company, we are extremely focused on the needs of our customers and constantly strive to deliver innovative products and solutions for their evolving needs. This year marked the launch of 6 solutions aside from our product innovations. One of our biggest launches have been FTTX Mantra, which is an innovative ready-to-deploy FTTX kit, and a True Ribbon, which is a 1728 fiber count cable for data centers as well as small cell solutions. The other interesting one is the S-Pods, which is an addition to our programmable networking segment, and our unique Lead 360-degree approach is now a key value driver for our customers who are looking at end-to-end network design and rolling out partners for faster and efficient data network creation. All these exciting launches and partnerships reside on the backbone of 271 patents, 3 innovation centers, and 2 software delivery centers. Our capacity expansion plans of 50 million FKM for optical fiber and 33 million FKM for optical fiber cables remains on track. Our new greenfield silicon to fiber plant in Aurangabad is built on world-class Industry 4.0 principles with high degree of IoT and automation. This plant is already under final installation and commissioning and will start gradual commercial production from the Q2 of the current year. At some point of this year, we would also want to arrange a plant visit for this new facility for our investor community, and I would request all of you to come and witness the engineering and technology behind the intricate silicon to fiber manufacturing. Another major development this year for us was the acquisition of Metallurgica Bresciana, which now has given us a point of presence in the heart of the Europe market, thus significantly increasing our market reach in that geography. We are seeing fantastic synergies between our India and Italy plant with integrated planning and supply chain. This for me is personally an extremely important slide. I think we don't talk about this enough, but our team at STL is continuing to become stronger by the day. We are attracting great talent for all our business functions. I'm glad to share with you that in terms of the talent profile, 74% of our employees are graduates and postgraduates, and 18% are working out of offices and manufacturing facilities outside India. During the year, we attracted some of the best global talent in the fields of technology, engineering, analytics, and further strengthening our overall technology expertise. Sustainability and governance continue to be an extremely strong pillar for the company, and we remain very committed to this cause. The company recently won the Zero Waste to Landfill certification for our cable facilities, and STL touched over 200,000 lives through our corporate social responsibility as well as volunteering initiatives in FY19, with a cumulative impact of over 830,000 lives. Okay, so this was FY19, a truly transformative year for us. What's next? We believe that the future looks even more exciting, and let me walk you through it. From where we are today, we see ourselves at an inflection point of mega trends impacting data network creation. Our hyper-connected world requires a hyper-connected network. I'm sure I do not need to emphasize more on the importance of hyperscale network in today's day, where there are at least 1 million use cases for building enormous bandwidth and automated networks. These networks, unlike the traditional ones, have 4 important characteristics. They will be denser. What I mean by denser is that the strong adoption of 5G macro technologies and LTE small cells will require a huge investment in the access layer with multiple points of connect, wherein each such point of connect is connected by fiber. Next, these networks will be deeply fiberized to fuel the requirements of ultra-low latency and ultra-high bandwidth. They are going to be vendor neutral and disaggregated. By disaggregated, I mean that the hardware and software will be decoupled, and software will be open, programmable, as well as scalable. Lastly, storage, transportation, and computing processing, everything will happen at the edge, closer to the point of consumption, leading to the creation of multiple edge data centers. And these new age networks are being created not only by telcos, but also by new players like the cloud companies, citizen infrastructures, as well as large enterprises. These are characterized by their rapid technology adoption cycles and deployment of best-in-class technology. They continue to have a significant influence on the industry structure, network architectures, and customer consumption models. What really is happening is something very interesting. If you look at the traditional telcos, they are evolving by moving their focus upward into the value chain, moving from network arbitrage to platform to apps and the cloud to apps. And what we see that cloud providers, the social network providers, are moving downwards from apps to platform to network creation. So to add to this network creation pie are the large enterprises like defense, railways, and the citizen networks like Digital India, NBN Australia, etc. This evolving model of data network creation is where the economic moat lies for STL. What is equally interesting is that this new mega opportunity is in making for us, which did not exist in the voice era. The emergence of new network architectures and new class of customer segments both are leading to change in consumption models. The customers are increasing their network volumes, the architectures are per se transforming, the underlying software architectures are transforming, leading to new application as well as use cases. And all of this has started to translate into change in the buying patterns and a need for an end-to-end data network solutions provider. We are seeing customers extremely excited and open to engage at a much deeper level on the innovation and end-to-end data network partner model, where the focus of our company exactly lies. For us, all these transitions and transformations are creating an enormous opportunity. Our addressable market continues to get expanded multifold. What used to be our addressable market of almost about $20 billion US in 2017 will be expanding to about $75 billion out of the total annual capex spend of $300 billion towards network infrastructure creation by 2023. And we are going about this through our 4-pronged strategy. We want to innovate more and more new products and solutions, shifting our focus towards high value-added products. We will enter into new customers and new geographies with market share expansion. And finally, we will expand into new market customer applications and adopt an integrated solutions-based offering. So we at STL are evolving as our customer expectations are. It is no longer about product features or volume of fiber kilometers or in-time delivery. It is now about co-creation with customers for their unique needs, optimization of total cost of ownership, and time to market for new offerings. In fact, FY19 saw a completely different customer engagement model. We revamped our model to move away from customer satisfaction to customer engagement. we now have a dedicated key account management team, which is with a dedicated designated key account manager who's responsible for certain customers for their end-to-end needs. And key account management forms an important part of our tracking measures. And our evolving customer engagement model came into existence principally for two reasons. One is that the customer's needs are moving towards an application-centric approach rather than a specific product or service level approach. And secondly, to have multiple and layered conversations across our business lines for our customers. This change in the way of engagement is in fact leading to deeper level of partnerships with customers. Internally, we are now beginning to look at the business not as connectivity products and network services, but rather as solutions of mobility, access, long-haul connectivity, network modernization, and data center based on the end customer application needs. With this solution-based approach and expansion of our offerings to fulfill the application-centric requirements, we are now working towards a deeper share of customer wallet. Our 75 billion total addressable market is built on the premise of new portfolios, new business lines, new customer acquisition, new geographies, and solution-centric model across the three layers of the network. We believe that this approach will lead to new and evolved demand drivers for FY20 and beyond. These include increased FTTX penetration in Europe and India, 5G rollouts kicking off in 2020 and picking up pace between 2020 and 2025, mobile backhaul fiberization in geographies like India, which is still a heavily under-penetrated market, increase in investments by OTT players creating opportunity towards data center interconnect in US, digital broadband spending towards rural connectivity in India, and network modernization by large enterprises like defense, railways, and oil and gas. The increased trend towards virtualization by the operators will also open new windows of opportunity for us as a full stack data network virtualized player. So our outlook ahead of us is a growing total addressable market of about $75 billion, out of which our current share is less than 1%. We are strongly positioned towards tapping this opportunity and generating value for our customers through our USP of end-to-end data network solution provider. And we see ourselves directionally continuing to strengthen our global market share in this new TAM as we have done in a structured fashion for all our business areas. This slide, as you can see, summarizes our present view of our customer segments, our offerings built on our 5 pillars of customer engagement, technology, talent, delivery and supply chain, and sustainability and governance. We are off to a promising start to FY 2020, reflecting high energy and positive momentum for our business and all-time high order book for more than 10,500 crore and much sharper visibility on growth for years to come. I would like to reiterate that we remain committed to our important milestone of achieving $100 million net profits in FY20 and delivering growth beyond, creating value for our shareholders. And as we step into the new fiscal year, to kick off this new growth path, we have given ourselves a new look with a new logo. The new fresh look symbolizes our transformation as a new age data network solution provider in the hyper-connected world, committed to delivering exceptional, durable, and quantifiable value to our customers. With this, I now hand it over to Anupam for his comments.
Thank you, Anand, and good evening to everyone. We had a fabulous quarter with all the key financial metrics of revenue, profits, and ROC showing strong growth on YOY and Q-on-Q basis. On the business side, one of the key developments during the quarter was our entry into one of the biggest cloud providers showing innovative solutions for data center connectivity. We had one of the highest patent filings in the last quarter, taking our total patent count up from 234 in Q3 to 271 in Q4. The last quarter also saw an increasing pace of execution of both Navy and defense order and start of the cable expansion in both our India and Italy facilities. Coming to the performance of the quarter, this has been yet another record-breaking quarter for us, with the highest ever revenue, highest ever EBITDA, and highest ever PAT, registering a YOY growth of 112%, 38%, and 47% respectively. The blended EBITDA margin for the current quarter is 18.3% as compared to the previous quarter margin of 22.8%. This is on account of the change in revenue mix, with services and software accounting for roughly about 50% of the revenue. I would say that about 300 basis points can be attributed to the mix, and rest 150 basis points would be on account of price softening for the fiber in China and some part in India. Going forward, we see percentage EBITDA margin to hover around in the range of 18 to 20% based on the mix and industry-leading ROC of 25%. I think it is important for us to spend some time on this slide. What we have done here is to show how the company's business is evolving. We are moving towards a much higher total addressable market in years to come, and looking at double-digit growth, which will be tapped through an increase in solution-based offerings and change in the capital employed structure. As we are adding businesses to the portfolio, we are looking at less capex intensive model, which will yield higher ROC to the business, albeit at lower blended EBITDA margin when compared to the erstwhile fixed asset heavy business profile. As is evident over the years, following this approach, we have been able to grow our absolute profits at double-digit rate and significantly enhance our capital productivity. We expect our financial profile at company level to represent a normalized EBITDA margins of 18 to 20% and ROC in excess of 25% with our evolving business mix. It is important for me to highlight that our guided EBITDA margins are a function of blend of different businesses with different financial profiles. On individual business segments, our endeavor would be to continue operating the business with a global-based margin structure through dedicated initiatives towards cost rationalization and high value-added products. In the process, we remain committed and continue to create value year on year for our shareholders. We have more than doubled our size in the last 3 years. Our revenue CAGR is north of 30% and EBITDA growth is 35%. Our profits have grown by 2.8 times in the last 2 years alone, and ROC is at 34% for this year. As company, we continue to focus heavily on not only growth, but also on the cost optimization and capital allocation. We will also prudently continue to invest in technology, talent, and customer engagement to drive growth for future years. As STL enters in the next phase of growth, the company has laid its financial priorities well intact under the strong governance standards. Our approach towards growth, earning, and capital allocation are well charted to help it grow in a value-accretive manner for all its stakeholders. The company's success will continue to be backed by a strong foundation of corporate governance that will enable its sustainable growth going forward. For your reference, we have captured an abridged version of the P&L and the balance sheet. Revenue, EBITDA, and PAT grew by 59%, 48%, and 68% respectively as compared to FY 2018. ROC for full year improved to 34% from 30% in FY 18. The EBITDA percentage 70 basis points from FY 18 on account of changing business mix with services and software business contributing more than 35% of the total revenue. The margin profile for our product business remains strong at 27.8%, and we have started to see some scale back business, which has resulted in EBITDA margins of about 11-12% in this business. Consistent towards our dividend policy, I am also happy to announce that board has declared a dividend of Rs 3.5 per share for FY 19, which translates to about 30% of our net profit. which is up by 75% than rupees 2 per share given last year, which is in line with our profit growth. Our debt has largely remained the same as compared to H1 2019, primarily on account of strong operating cash flows and similar level of capex payouts. I'm happy to see our net debt to equity ratio coming back towards our stated range of less than 1. On net debt to EBITDA ratio of 1.5x, we are fairly comfortable, much below our stated range of 2.5x. Before I end my commentary and open the floor for questions, I would also like to take a few minutes to address two concerns that the market have seemingly gotten worried related to us. Firstly, there have been a series of news flow on the backdrop of one recent China mobile tender that the prices for extended fiber or cable saw a sharp decline driven by local suppliers. This has led to a general market perception that the pricing structure of this industry has disrupted and it would affect all the players globally with the same intensity. I would like to clarify that we see this development as more localized to a particular geography, and while it had some ripple effect on the global pricing, we do not see this disrupting our financial profile in this business. Through a mix of higher volumes, higher value-added products with better realization and our ongoing cost measures, we are confident of profit growth in our product businesses next year and even following years. Second, related to promoter share plays in STL, we would like to share some facts and details which are already in public domain. The Vulcan Group, which is the ultimate promoter holding entity, which had taken a loan from international banks for funding the delisting of Vedanta Resources from London Stock Exchange. As per the security collateral for this loan, the shares of Vedanta Resources, Sterlite Power and STL were placed last year around September 2018. The current loan outstanding is about $900 million to be paid in tranches over the next 3 years. The security cover will be tested on quarterly basis and is not subject to daily margin requirement. To that effect, the last quarterly testing happened in Feb 2019 and security cover was found sufficient. The underlying structure of facility agreement with Global Bank is such that it is highly unlikely that the promoter share of STL would come under any risk of open market selling. The group remains fully committed to their shareholding in STL and extremely bullish on business prospects. With this, we come to an end of our presentation and would now be happy to take questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aniket Pandey from Prabhudas Lilladher. Please go ahead.
Hello. Hello.
Yes,
Hello.
Aniket.
Yeah. Thank you for the opportunity, sir, and congrats for the strong revenue growth performance in this quarter. Sir, my first question was regarding the TAM actually. So I understand that you are trying to focus on increasing your TAM. So can we get a clarity on what steps you are taking to bring more factors under, what would be the revenue growth drivers for increasing your TAM?
So, Aniket, there are several ones. One clearly is on the portfolio that we have for connectivity solutions, our products business. We are increasing the scale, we are increasing the overall size, we are increasing the value-added products, and we are increasing geography. And at the same time, in the services and software business where we are doing, where we have a great sort of offering and positioning in India, we are intending to take that business global with 1 to 2 customers that we'll be looking at this year. And the fact that the overall networks, the way that data networks which are getting built are being built in a very different fashion, which they are being built in a disaggregated manner. They are being built by different providers other than telcos. So that all these options and optionalities increases our TAM tremendously. And you would have seen that the fact that our order book itself has grown up from 2,500 crores to 10,500 crores because of our capability to access these new markets and these new opportunities at a global fashion.
Okay. And sir, you mentioned that your 37% of the revenues came from enterprise and citizen network and cloud. Okay. So can we get a clarity on that? So basically this would be accounted into your services revenues, right?
So this is across. So as we have been now mentioning that what we are doing is for various sets of customers. So citizen networks will be, say, for instance, BharatNet. So for BharatNet, we'll be selling them the cables separately, but at the same time we'll be building networks. So for enterprises, it will be different. Again, for them, we will be selling the products separately and building the networks. And within services, at times, the opportunities for both products and software are also included. So
what does the revenue mix looks like in this quarter?
Between?
Sir, what is the revenue mix in this quarter? I mean, product and services in this quarter?
It's close to about 50-50. About 52% is services and 48% is product, something like that.
Okay. And sir, in order book, what is the mix? Hello?
Yeah, order book is about 5,500 crores is products and 5,000 crores is services and software.
Okay. Okay. Thank you, sir. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one per participant only. The next question is on the line of Kunal Sangoy from Aditya Birla Sun Life Mutual Fund. Please go ahead.
Yeah, thanks and congratulations to the management for a very strong set of numbers. My question is with regards to the realization on the fiber side. You did indicate that there has been some softening in the China market as well as in India. So if you can elaborate a little more with regards to, what kind of quantum decline has been there in terms of cable as well as fiber?
So Kunal, overall, as we've been maintaining that business operates in the price range of $7 to $8, and over the last couple of years, we were seeing it on the northern side of closer to $8. We have seen some degree of softening happening essentially in China and India, where the pricing has reached closer to $7 levels. At the same time, for us as a company, we have this mix of long-term contracts in Europe as well as what we do in India. So the average pricing has been between $7 and $7.5.
Right. So do you see incrementally, given that, most of our contracts are long-term, but the incremental contract that we sign up for, say, CY20 and beyond, there you see, the pricing getting tagged at the lower end of that range?
We haven't seen that, and we haven't even seen the impact of any of this pricing reaching Europe or US. And since bulk of our sales for the product business happens in those areas, we clearly believe that whatever has happened due to this one tender, which was due to stock levels reaching extremely high levels in China, this is more of an aberration rather than a continued situation.
Yeah, fair enough. And with regards to India, how
sorry
is
to
that?
interrupt, Mr. Sangoy.
Yeah.
Sir, may we request that you return to the question queue? There are participants waiting for their turn.
My question is continuing, so if you don't mind, with regards to the India pricing, I need to just check.
Sure. Yeah, go ahead, Kunal.
Yeah, sir. So with regards to India pricing, wanted to understand.
So Kunal, India price at global, it is extremely similar pricing levels. So India pricing has some more localized influence of what we saw in China and Asia, but it's not extremely disaggregated or disintegrated from that from the global pricing levels.
All right. Okay. Thanks. I'll come back for the later.
Thank you. We'll move on to the next question. That is on the line of Mukul Garg from Haitong Securities. Please go ahead.
Thanks for taking my question, and congratulations to the management for the stellar revenue growth this quarter. First, Anand, if I look at the revenues, for this quarter, and if I compare that, with the increased account receivables and contract assets, it looks like there is a very healthy component of the Mahanet and Indian Navy contracts and these. Can you help us with the progress on these two contracts? How much has been completed in fiscal 19, and how this will flow out to FY20 onwards?
So, Mukul, overall, the contracts are fully on track and on target. I can only tell you that about of the total revenues that we did in FY19, about 37% of it comes from services and software, which includes Navy, which includes Mahanet, which includes rollout for the telco providers, which includes the smart cities. I would not be able to give you numbers contract-wise because it's not right, and it's the contracts are all running on time.
Understood. If just to continue on the contract assets, because this has come in for the first time in your balance sheet, should we expect this to increase going forward as you move more into steady state on Indian Navy side, or this will start clearing off from next few quarters? Just if you can help us with how this will flow through.
Sure, Mukul. This is Anupam, and I would address this question. So in terms of this current assets, other contract assets and receivables, so as we move towards services businesses, and that business is becoming like larger share at 50-52% right now, so it will flow in line with the revenue mix, and I can't really give what kind of range it will play out, but as we complete the project, some part will get into receivable and then collection and all that. So it's a cycle from inventory to current assets to receivables. So it will be in line with what revenue we will have. It's just a classification. Otherwise, it's a part of that inventory, receivables, and those kind of things.
Got it. And if I may ask one bookkeeping question. Just one bookkeeping question. It will take just a little minute. If you can just help us with the margin profile in the products and services business lines this quarter, and any utilization figure for the same.
So utilization, Mukul, has been in line with the previous quarters, almost 100% capacity utilization. We are operating at product level. In terms of the margin profile, the services business is doing close to 11%, and it's moving up now, because as we see larger volume, larger revenue coming in, so economies of scale benefits have started coming in. In terms of the product margin, currently at about 26% for the quarter. Full year it was about 29-30%.
Understood. Thanks for answering my question, and best of luck for fiscal 20.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Mr. Shashi Bhushan. The line for the current participant has dropped off the queue. We'll move on to the next question. That is on the line of Neerav Dalal from Maybank. Please go ahead.
Thank you for the opportunity. I would want to know, when would the new facility start to contribute to the revenues? Would it be from the third quarter onwards or second quarter onwards?
Yeah, Neerav, the commercial production will start in Q2. I think we'll start seeing any material revenue coming in from Q3 and Q4 only, H2 of this year.
Okay, and very quickly, what would be the optical fiber cable prices at the moment?
Cable pricing is just a derivative of the fiber pricing plus the margin. So it's in a range based on the various types of. We look at that from a margin perspective, and the margins for optical fiber cables continue to be the same that we have always had.
Okay. Thank you.
Sure.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Thank you very much, sir, for the opportunity. Sir, just wanted to understand on the profitability front. FY19, we did about $85 million. Fourth quarter, we were at a run rate about $92 million. But we are still guiding kind of $100 million profitability next year. So, given that last 4 years we have grown at a CAGR of 54-55%. So, is that what we are looking at, tapering up our growth in terms of profitability? Maybe
Deepak, typically as a company, we do not give out any guidance. We had created a directional frame in 2017 where we said we will deliver at least 100 million profit by FY20. We are saying we continue to meet that commitment. Definitely by the way we are performing, you are essentially saying that we should be able to exceed it. Maybe we will. But we are essentially saying what we committed in 2017, we will at least deliver that in 2020, FY20.
Oh, okay, understood. And in services and versus product mix, how do you see that in next 2 to 3 years in terms of revenue mix?
So it's increasing year by year. So last year, services and software was about 26%. This year, it's close to 37%. Order book is close to 50-50. So I think it will inch from, say, 37% going towards 50% over the next couple of years.
Next couple of years. And that is what will kind of result in EBITDA margin dilution.
Absolutely. Absolutely. That's why we are guiding that progressively the EBITDA margin would be in 18 to 20% range, but the ROC will start getting healthier.
Yes, I think one more thing I would add, Deepak, that we continue to talk about absolute increase in EBITDA growth, and second, within the boundary line of ROC. So as long as these two things are maintained, I think that delivers good growth with discipline of ROC.
And this is happening on the backdrop of the fact that our fiber facilities towards 50 million are getting commissioned, our cable facilities start coming online. So we'll see good granular growth on both the businesses. Services will definitely grow faster because it's coming from a smaller base.
Absolutely. Fair enough. All the very best and
thank you
from my side. That's it from my side.
Thank you. We'll move on to the next question. That is on the line of Harshit Patel from Equirus Securities. Please go ahead.
Hi, sir. Congratulations for a very good set of numbers. Sir, I have two questions. The first, so sir, we had earlier guided that 10 million fiber kilometer of capacity would be operational by March 19. So, will we get to see some amount of volumes in the first quarter of FY20?
Yeah, Harshit, that has started and we are already doing some sort of trial and commercial production for 40 million. This, as I said, the material volumes will start coming in from H2. There is some small volumes which are even coming in the current month as we are moving.
Okay, so you are saying that we had some sort of benefits from the additional volume in the fourth quarter itself?
No, the current in Q1 we are seeing some volume coming in, but it will not be material enough for either our volumes, revenues or margins.
Okay, understood, sir. And sir, on to the second question. So sir, what do you think would be our blended capacity utilization for our new facility, which is 20 million fiber kilometer in the next year?
We are planning to run the capacity at its full level, and because fiber runs at gives the best operational leverage at full capacity, and we are completely planning that FY21 we run it at its full capacity.
Okay, sure. That's all from my side. Thank you, sir.
Thank you. The next question is on the line of Ashish Kacholia from Lucky Investment Managers. Please go ahead.
Hi sir, Saurabh Podar here. I have a question regarding the order book. Out of the 5,000 odd crores product order book we have, can you give the geographical mix? How much is export, how much is within India, sir?
So Saurabh, it would be almost 70% of that will be exports and largely Europe dominated. So India currently we have larger outlook, but it keeps moving more in terms of quarter to quarter delivery confirmation.
Understood. Thank you, sir.
Sure.
Thank you. We'll move on to the next question. That is from the line of Riya Mehta from Anand Rathi. Please go ahead.
Hello. Hello.
Yes.
Congratulations on good set of numbers. Sir, basically, you said you are diversifying in the geographical location. So, could you give a glance on which all geographies are you planning to expand into, or where do you see major traction coming from?
So Europe, we are continuing to deepen our presence, and we have seen the Europe region. We are strengthening our presence in Middle East and Latin America. And we are starting to do some forays in North America as well, as we have started some sales in North America, and we will, over the next 2 to 3 years, have North America also as an important market for us.
Okay, so and in order to capture the North American market, do we see any other inorganic form of growth, or
the plan is all organic, and we have been investing in that market over the last couple of years, and currently it's all in organic plan.
Okay, thank you.
Thank you. We'll move on to the next question. That is on the line of Agastya Dave from CAO Capital. Please go ahead.
Thank you for the opportunity, sir. Sir, I have to ask like 2-3 questions. So, the appointments, can you elaborate a bit more? There were 3 new appointments, especially one that was interesting from the data analytics side. Could you elaborate what you're planning there? Second, sir, on a quarter-on-quarter basis and on a year-on-year basis, if I do incremental data on incremental turnover, our margins are like really compressed. So you mentioned 400 basis points.
Sir, your voice is breaking up.
Sir,
I would request you to use the handset mode while speaking because we're not able to hear you. Hello? Hello, Mr. Dave? The line for the current participant has dropped off the queue. We'll move on to the next question. That is on the line of Alok Deora from Yes Securities. Please go ahead.
Good evening, sir, and congratulations on the great set of numbers. I had a couple of questions. One was on the capex. So what kind of capex we are looking for FY20 and 21?
So, Alok, we have done in the current year. It's essentially the last part of the capex which will happening for the 50 million, and the bulk of the capex that we will be doing for the cable facility. So we'll be between 500 to 550 crores we'll be spending this year.
Okay. And sir, just wanted to know, like we are reaching around 50 million fiber capacity by June 19. So currently, what is the capacity run rate we are operating with? Because I believe some bit of it must be already operational, right?
No, so we are currently running at our the normalized capacity of 32-33 million. And the 40 million commissioning is currently happening, and as I said, some part is happening, and the 50 million will start happening after June. So in H2, we will see some sort of volume impact of the new capacity.
Right. Okay, sir. Just one last question, if I may. In China, we have a very little exposure. So are we looking at, penetrating more in that market, or are we, happy with the demand which we are seeing from Europe and other regions?
We are continuing our presence in China. So China is about 5% of our sales. We'll continue to have a presence in China, and we'll continue to grow in other markets. And as China market also improves, we are continuing to be extremely bullish on China as a market as well.
Okay. That's all from my side. Thank you and all the best, sir.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Shashi Bhushan from Axis Capital. Please go ahead.
Hey, thanks for taking my question and congrats on good quarter. So, I have a couple of bookkeeping questions. There is sharp jump in your trade receivables and contract asset, like almost 2,500 crore odd. Is it largely because of some of the Navy contract or BharatNet contract? Can you give some color on this?
Yeah, so Shashi, you're right that as we are executing the projects, so a lot of work is happening on the ground, and therefore the assets are appearing partly in receivables increasing and partly in other contract assets. So as we continue to move towards our services, some of that will get into collection mode from the Q1 onwards, and some of that will continue to appear in these categories.
And also the trade payable has increased by 1,900 crore. Any input on this as well?
So basically the way we are working, we have some of the bought out materials for which we have the matching payment profile. So this is how we are able to have our contract worked out so that we don't really have to be cash out during the execution of the project.
Yeah. And also, if I look at your PP&E and CWIP, that has jumped by 600 crore in this quarter compared to the last quarter.
Yeah, so that's essentially the work which we have done in the project for 50 million capex expansion. So that is what we are seeing. So it's not the last quarter, maybe you're referring to the September quarter end where we publish our balance sheet. So from that perspective, yes, in last 6 months or so, that kind of number would have gone up. And plus, we also had metallurgical Bresciana reclassification of certain assets and all those kind of things.
Oh, okay. So all those have come in this quarter.
Yeah.
And we are guiding for 500 to 550 crore of capex for the next quarter.
Capex out.
Next year.
That's sorry. Yeah. Thanks a lot, and all the very best for the next year.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Agastya Dave from CAO Capital. Please go ahead.
Thank you for the opportunity, sir. I've been just calculating quarter incremental EBITDA on incremental revenue and also YOY, same number. And this time the number has is it a lot to do with the bought-out components that you just mentioned, that we have got a huge bump up in our revenues this year, where we'll earn very little on the bought-out components? Is that the biggest reason, or is it just what you described?
Agastya, your voice is breaking again. So we're getting part of your question, we're not getting the entire thing.
Maybe I'll take it offline, sir. Irony of ironies. Thank you.
Thank you. We'll move on to the next question. That is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Thank you for giving us an opportunity. Can you little bit, in fourth quarter, while revenues witnessed significant increase, but margins are actually almost like collapse. So was it any one-off? Was it any bought-out item kind of thing, which is resulting into higher revenue but lower margin? That is question number one. And the related question is, if your guidance is 18 to 20% margin, then do you think this kind of a revenue growth, what we have witnessed, will continue at this kind of a pace?
Rajesh, I think you'll have to understand the texture of our business a bit deeper. So there has been no collapse or anything like that. The margin mix has shifted, and it has been shifting in a very structured fashion from Q1 to Q4. So Q3, the margin shift was about 67% was products and 33% was services, which has moved to 52% services. And these two businesses characteristically have different margin profiles. And that's why quarter on quarter you see a margin shift.
So have you from here on, as you move into 1Q of FY 20, the product business, it is 67. It is how much right now in fourth quarter you mentioned?
48% in fourth quarter. And we do not look at businesses from a quarter to quarter perspective. And that's why we are.
How much is product?
No, please understand, for the overall year, the products was 63% and services was 37%. And that's the overall outlook. What I said earlier, that in structured way, the products and services will move from last year it was 26%, moving to 37%. And in the next 2 to 3 years, it will move closer to 50%. And that's where we are guiding. The margins overall as a company would be a mix of the two businesses, staying between 18 to 20% and with a high ROC.
But then in that case, your working capital, because you said that it is going to enhance your ROC as you move more towards, the services business, while it may dilute blended margins. But if I look at your, revenue growth versus your on full year basis, since you say that let's not look at quarter on quarter, on full year basis, the increase in working capital is significantly higher than increase in revenue. So how do you justify that?
So basically, if you look at when we are talking about ROC, is a mix of fixed assets and the working capital. So in services business, the working capital, as we have been explaining, is slightly higher than our product business, but if you look at it, doesn't require us to invest in fixed assets. So these are the things which we need to understand. Maybe we'll have to spend some time with you to make you understand the overall business characteristics. For the product business is asset heavy, where we need to invest in fixed plant and capital, and therefore the growth comes from there. In the services business, which is more the asset light model, where we have working capital as the only asset.
Okay. It would be great if you can, from next presentation, probably you can give product services breakup in presentation itself, so that we don't ask question on this.
We have explained that maybe in our opening commentary we explained that, and maybe we can explain later.
No problem. Thank you, sir. Wish you all the best.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah, thank you for the opportunity. So just trying to connect your comments on pricing and the margin performance and the backlog. You said that the pricing is now closer to $7, in that $7 to $8 range. Just wanted to know whether this pricing has slowed down to your margin, and this pricing is now reflected in your new order backlog, and generally a large portion of your business is fixed price. So just wanted to know if this new pricing is there in the backlog and the margin what you reported for quarter 4.
Yes, Pritesh. So some part of that pricing has flown into the quarter 4 margins, and that's where we talked about that the margins of the product businesses, which used to be at 28.5%, has moved to 26% during the quarter. For the whole year, the margins have remained almost similar for the product business between FY18 and FY19. But we think the margins, the normalized margin for the product business will be at 25 to 26%. Services will be closer to 11 to 12%, and the blended will be between 18 to 20%.
Okay. So and the new backlog that you have, or let's say the backlog that you have is on the new pricing.
Absolutely.
Okay. So just to clear here, incrementally what we see is about 26% odd margin on the products business.
Yes.
Which was also in the quarter 4.
In the quarter 4, it was 26%, where a large part of it has moved in. And the product business, this has been the characteristics margin between 24 to 26%.
Okay. My second question is on the working capital intensity. So just wanted to understand when you do the projects business, because this was one full year where we have a huge change in the mix as well as the acquisition. So now the working capital intensity, which we see in the balance sheet at about 20% of sales, is that the working capital intensity which should look forward with a rising bias because your product mix will keep on changing in favor of services, or you have any other comments here?
So essentially, in terms of the overall number of days for our net working capital, they have not changed significantly. So we were at about 555 crores when the revenues were about 3,200 crores, so closer to about 70 days of working capital. And we are closer to about 75 days of working capital with 1,000 crores of net working capital on 5,000 crores of revenue. So as an overall mix of, as we continue to run both these businesses prudently, and the reason why we are expecting the return on capital employed to be high is that we continue to operate this business with similar or slightly higher net working capital, but without any fixed assets.
But at the ROC level, is it similar to products business or higher than products business?
It is higher than products business, and that's where we have continued to maintain a guideline that we will generate ROCs of north of 25%.
Okay. On the capex side, sir, you mentioned 500.
Sorry to interrupt, Mr. Chheda.
If you don't mind, I'll just have a clarification here, ma'am.
Please go ahead, sir.
Yeah, sir. On the capex side, you mentioned about 500 crores. Now that was for FY20, and that's growth capex. What will be the maintenance capex, if any, or it includes here, and what will be your capex for FY21?
So this 5 50 or so includes the maintenance capex, and as we move forward in FY21, it will come down to about 200 to 250 crores, something of that order. It will be in FY21, it will be the final stages of our cable capex actually getting established, and post that we do not have any current programs.
And what optic fiber volumes would you record in FY20?
It's difficult to say that right now. Let us have the plant established, commissioned, and we can give you more color on this at the end of Q1 and Q2.
Okay. Thank you and all the best to you, sir.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Varinder Bansal from Panthomat. Please go ahead.
Well, thank you so much for taking my question. Most of the questions in my mind have been answered. So just can you update us on what is the latest pricing on the OF side in China right now, spot and long-term rates?
So Varun, we do not, as we said, we focus more on overall markets. And for us, it is between $7 to $7.5. And we do not operate in spot markets in any case. So for us, it's difficult to comment on these numbers for China market.
Have you been requested at all by long-term players for the upcoming capacity for renegotiation at all?
No, not currently.
Not currently. Okay, thank you.
Thank you. The next question is from the line of Nitin Rao from Alpha Ideas. Please go ahead.
Thank you for taking my question. So my question is related to the services business, and it is going to play a big part in our revenue mix going forward. So my question is, the services that we provide to our customers, are they similar to IT services in the sense that they are sticky revenues? So let's say after 1 year the contract gets over, chances are very high it will get renewed, or is this one time when we deploy the network?
So Nitin, initially it is there is a capital part of the revenue. So of the order book, typically about 70% of that is the capital part, which gets deployed on a 2-year basis, and the 30% of it is in terms of annuity for typically 7 to 8 years after that. So the way we look at it, we finished one contract for Army, which was a 1,500 crore contract. So now it's moving on to AMC phase, which is about 500 crores. Our Navy order, which is 3,500 crores, about 2,500 crores is CapEx, 1,000 is AMC. So the AMC parts start getting accumulated, and from FY22 and FY23, the AMC part starts becoming a significant part as we move forward. Right now, the bulk of our revenues is coming in from the CapEx part, but as we have executed, say, over 10,000 crores of orders, the AMC parts start becoming more and more important as well.
Great. Just a follow-up to that. So are we saying that our services business will only come in to those customers whose networks we have deployed?
Yeah, that's clearly our focus. We do not do services or AMs, at least management of networks that we do not create. That's a conscious call, and since we are seeing great opportunities of network creation across customer segments, across geographies, we will be maintaining that approach.
Okay. Thank you so much, sir.
Thanks.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Dr. Anand Agarwal for his closing comments.
Thank you. And this concludes the STL Q4 FY19 earnings call. I would again like to thank everyone for attending this call and for showing interest in our company. I hope we were able to address and clarify all your queries and comments, and for any further questions and discussions, you can feel free to contact the IR team, including myself and Anupam, and we look forward to continuing the conversation with you in the future. Thank you.